Hello, everyone. I'm Xintong, and I'm excited to talk about our recent work where we propose combinatorial financial options and study the design of both standard and combinatorial options market. This is joint work with Dave, Nikhil, David, Biaoshuai, and Mike. So I'll first start with some background on standard financial options and then get into our main contribution. So there are two types of options, calls and puts, and a call option gives the contract holder the right to buy an underlying asset for a strike price on a future expiration date. For example, someone purchases the following call option at $8, which gives the right to buy the S&P index at the agreed $4,500 on the last day of the year. So if it turns out that the S&P index is 4,600, one will exercise the option, pay only 4,500 and receive the index. Whereas if the S&P price is 4,400, one will forfeit the option and the $8 will be the sunk cost. Therefore, the option's payoff is a function of the underlying asset value at expiration date, denoted as ST, which is a random variable as of today. So specifically, the payoff is the maximum of 0 and the asset value at expiration minus the strike. The other type, put option, gives the right to sell an asset at an agreed price. And then one will exercise the option if the S&P price is lower than 4,500. So the payoff here is the maximum of 0 and the strike value minus the asset value at expiration. So here, what I show is a screenshot of part of the S&P 500 options market, which offers options across different types and strike value. The way current exchange works is that it features a set of predetermined strike values and uses separate markets to independently match orders on options of a specific type and strike value. So even though they're all dependent on the same underlying asset. And this prescriptive and independent design restricts investors from specifying custom strikes and fails to match options with different strikes. And this can often lead to the thin market problem, where investments get diluted across all the independent markets, even when traders are interested in the same underlying asset. So our first contribution of the paper addresses this problem and designs a mechanism to consolidate such independent markets. So it provides investors the flexibility to trade custom strike prices and aggregates and matches orders on options related to the same asset across different types and strikes. So let's consider an option market on a single underlying asset S with the same expiration date. So there are a total of M buy orders and N sell order. We represent each order of an option by an option type -1 for the puts and 1 for the calls. And also a strike price, a bid or ask price for the order. And the payoff function follows the specified option type and strike, where this S is a variable representing the underlying asset value at expiration. And the exchange aims to match buy orders to sell orders submitted by traders. Specifically, the exchange decides the fraction to sell to each buy order and the fraction to buy from each sell order. And upon expiration, the exchange can exercise spot options and needs to fulfill obligations for the sold ones. So the goal here is to maximize profit from matching orders subject to no payoff loss in the future, regardless of the realization of this S at expiration. Therefore, the total payoff of sold option should be no larger than the total payoff of bought options for all possible values of S at expiration. We further extend the previous formulation to incorporate an extra decision variable L, which represents the potential payoff loss or gain at expiration date T. And in practice, we can also incorporate some time value on this L into the objective. And in the paper, we illustrate with real market examples and show that incorporating this L enables more trades. So I'll only provide some iteration here. So when L is positive, the exchange allows some worst case deficit at option expiration, only if it is preemptively covered by some surplus or revenue at the time of order transaction. Whereas when this L is negative, the exchange allows a temporary deficit or expense at the time of order transaction if it is guaranteed to earn the deficit back at option expiration date. So now we're ready to express the matching mechanism using our defined notations. So here's the full formulation, where the profit is revenue from selling to buy orders minus the expense incurred by buying from sell orders. And in terms of computational efficiency, we show this mechanism takes time polynomial in the number of orders in the market to find the optimal match, even though we notice that this S can have an infinite number of states. So specifically, the left-hand side of this constraint is a piecewise linear function in S so that we can solve it by satisfying constraints defined by S value at breakpoints, which are just the distinct strike values. Therefore, the mechanism is a linear program with the number of constraints equal to the number of distinct strikes in the market. Okay, so up to this point, I discussed consolidating options with different and custom strike values to improve the economic efficiency of standard financial options market. Our second contribution extends standard options to define combinatorial financial options that specify the right to buy or sell a linear combination of U underlying asset for a certain strike price on an expiration date. For example, the following call option specifies the right to buy 1 share of Apple and 1 share of Microsoft at a total price of 300 by the end of the year. And the payoff will be a function of both Apple and Microsoft price on the last day of this year. So there are indeed some existing special combinatorial options, which include options on the S&P 500 index, options on the Dow Jones Industrial Average, where each underlying asset has a certain pre-specified weight. Cboe has also recently launched an option on 11 different sector indices. The option here specifies the right to buy Apple and sell Microsoft at expiration for zero cost, which means this is essentially betting on the event that Apple will outperform Microsoft. Therefore, unlike standard options speculating on price of a single security, combinatorial options speculate relative movements between assets. Therefore, running such a market can enable the expression of demand based on the predicted correlations among those underlying assets. However, matching combinatorial option orders can be challenging. Using independent markets for options of each distinct combination of assets and weights may not be enough. First, the number of markets can grow intractable, exacerbating the thin market problem. Second, such design may fail to match orders on combinatorial options of different asset combinations. I'll further illustrate with an example. Let's consider this market with the following combinatorial options that are written on 4 different asset combinations. The exchange returns no match if it only considers options related to the same underlying combination. However, a valid match does exist by selling to O1 and O2 and buying from O3 and O4. So it costs the exchange $0 and may yield a positive payoff in the future because the total payoff of sold option will always be no larger than the total payoff of bought options, regardless of any realization of the underlying variable ABC at expiration. Therefore, our goal here is to design a market to match orders on combinatorial options written on different combinations of underlying assets. So here, I show the previous formulation we use to match orders on standard options, and we would like to generalize this to this new combinatorial market. The idea here remains the same, except that we substitute the single underlying asset with a linear combination of U underlying assets, where alpha and beta here are the corresponding specified weight vectors in front of each underlying asset. However, now this constraint is a function in the U dimensional S, and unlike the standard options formulation, the number of constraints can grow exponentially as we consider combinations of possible future values for each underlying asset. And indeed, we prove this matching problem is co-NP hard. Since it's no longer practical to identify all constraints defined by the S vector, we propose to find the exact optimal match through iterative constraint generation. So we gradually build up this constraint set C, which includes S values that define different constraints when we plug this S value back into the formulation. So we start with O underlying asset of price 0, and we first use a linear program to compute optimal match that satisfy this restrictive set of constraints. We then design a mixed integer linear program to find the S that violates the optimal solution the most. So this is basically the most adversarial realization of S that gives the worst case payoff loss for the given optimal solution. We then include this as into the constraint set, repeat until no such as violate the matching solution. Therefore, the final number of constraints is simply the number of iterations that takes the algorithm to terminate. We evaluate this proposed constraint generation algorithm on synthetic markets by constructing combinatorial option written on 2 randomly selected underlying assets. Order prices are calibrated using real market standard options on each related stock. And we further add noise around prices to control the likelihood of match. And we are interested in markets that vary in scale. So basically vary in the number of orders in the market and vary in the number of underlying assets options can be written on. The figure here shows the number of iterations that takes to find the optimal match and the net profit from the match, as we vary the number of orders in the market. And we fix these market to for underlying asset. So as one may expect, we find an increase in net profit as transactions are more likely to occur when a market aggregates more orders. And we also find the number of generated constraints grow only sublinear in the number of orders. And we further vary the number of underlying assets and fix the total number of order to 150. We see here as the dimension of this S becomes large, we find a faster increase in the number of constraints and a steady decrease in the net profit. So this suggests that the thin market problem may still occur even if we consider a very large, when we consider a very large set of underlying assets without aggregating enough orders. So one note we want to say here is that here we make the assumption that every asset pair is equally likely to be traded, whereas in a real market, investors may be more interested in certain asset pairs, trading them more frequently than the others. So in the paper, we showed with experiments that such concentrated interest in certain pairs can indeed lead to a faster convergence and higher profits, attenuating this thin market problem. So to briefly summarize, in this work, we propose a mechanism that can efficiently aggregate orders on standard options of different types and strike values, but related to the same underlying asset. This mechanism enables the trade of custom strike price and can improve market efficiency by matching orders that would not transact under current independent market design. We further introduced the combinatorial option that specifies the right to buy or sell any linear combination of underlying assets. We show this increased expressiveness comes at the cost of higher computational complexity and propose a constraint generation algorithm to find the optimal match. We demonstrate its practicability on synthetic combinatorial options market. And that's all for my talk. Thank you everyone for your attention.